Welcome to Investors Insights. Our topic today is domestic strengths versus international alarms. Good morning, gentlemen.
Good morning.
I want to talk today a little bit about the markets in this year. We're in August. Can you believe that? And with that, we started the year of January where the market had a lot of strength. Everybody was saying, hey, with tax cuts, deregulation, this market's going to continue marching on just like 2017. And then February came about, and geopolitical and U.S. political issues taking place, tariffs, all that conversation brought this market down with a correction of 10%, and we've been struggling to get back. You agree with me on that?
Absolutely.
But in the interim of that, with all the noise and headlines, what we have seen is corporate earnings continue to go up. And as corporate earnings go up, the price of stocks should start reflecting that earnings growth. Now, that said, though, we go into meetings, we go, well, we got to be concerned about this and concerned about that. Agreed?
Right.
So today you brought up an interesting point about jobs.
Yep.
So while all this noise is going on, talking about jobs, but we got corporate earnings continuing to improve. So talk about that.
Yeah, we saw, like you're saying, corporate earnings so far are up 23%. That's positive. Companies make money, they hire people.
Right.
So we assumed that the jobs numbers would be great this month. Expectations were for 90,000 new jobs to be added in July. Only 157 were added, so that looks like a huge miss, and it is. It's a big miss, very disappointing. But if you look under the cover on that, a little over 30,000 of those jobs were Toys R Us going bankrupt and finally liquidating in this month. So that added about 30,000 of new employees that are without jobs. So that kind of skewed the number, and we'll probably see that ratchet back up next month. Then you look more deeper, the largest loss of jobs wasn't even in retail, who had that 30,000. It was in government, which lost 13,000 jobs. And then manufacturing added 37,000. So we were concerned, if we saw a weak job number, it was probably because of tariffs. Well, manufacturing actually was stronger than expected, which would be impacted by tariffs. So you kind of dig through the numbers. This looks like a really actually strong jobs number, not a weak one. And that's what you really want to see, is just back to back to back strong job growth, because that's companies hiring, earning money, hiring people, and those people can go out and buy things, which is how we get the forward momentum in this economy.
Right, and that's the purpose we do these vlogs, to let people understand there's more detail to the data than just what they hear or read in this noise. And it's also a theme that we've had throughout the vlogs about how technology is changing business models. Case in point on Toys R Us, online shopping may have had a huge impact on them, and I think we'd all agree on that. At the same time, though, Bobby, as we talk about domestic strength here, we've got international alarms going off. And you brought up some points about that in this morning's meeting.
Yeah, so domestically, we're looking really good. GDP north of 4%, strong corporate earnings, like you said earlier, and then a strong jobs market. But there are alarms overseas. There are. In Europe, we saw slow down first, second quarter. We're already starting to see Brexit talks fall apart. So that's already affecting the third quarter growth in Europe. And then in Japan, the consumption tax that's supposed to go into effect next year are keeping the consumers off the sidelines. And so the concern there is the Bank of Japan, they're out of the monetary tools for economic growth. They've already used all their tools. In China, tariffs are starting to have an impact. We're starting to see a slowdown in China. And so it is a global economy. As strong as we are here domestically, there are some international alarms going off. So we have to watch that carefully. So also we're going into a stretch here, August, September, that are the 2 months are worst for the market. So something to keep, something to watch carefully. Our markets are stable, again, with a good economy, but that we do have to take that into effect.
Yeah, a couple of things there. I always say that the new year actually begins as school starts back up and everybody comes back from vacation. They go, oh no, do you know how much money we spent on vacation? I've got to pay taxes. I've got holidays coming up. I've got to get this budget under control. And how's my stock portfolio doing, by the way? So that tends to be reflected within the markets. And the other point I'll make is a theme throughout our vlogs has been business models changing with technology, for example, and then also from the standpoint the tariffs aren't that big of an impact to the United States. They're impacting China more. They need us more than we need them at this point. So on that note, we're going to keep you informed as we see the earnings reports continue to come in. We think that we've still got strength and momentum here. The point we want to make to you is that with that domestic strength, we're not hearing alarms in this country. Still have midterm elections. Hold on, folks. It's not dull. And we're going to keep you updated as we continue moving forward on these changes. Thank you for taking time to watch this vlog. Let us in your home, your offices, on your phone. And at the same time, we appreciate those of you who share it with others immensely. We appreciate all that feedback. Go and have a great week. Let's start August off and look forward to talking to you soon.